All right, let's move on. In this clip, we're going to cover some more details about bonds, who issues bonds, and a couple of other things that are relevant to bonds. So let me get a seat here. Oh yeah, ooh, feeling good, feeling good. All right, I'm going to give a shameless plug to my favorite lunch place here in Searcy, KJ's, out there off of Race Street. Go past Walmart, go past Chili's. The road will bend around to the left, go north, maybe a mile through a four-way. There's a stoplight, and on the right it's KJ's. They make good breakfast and also great fried chicken on Wednesday and fried pork chops on Thursday. It's a meat and two with a drink and ice cream for $8, so you can afford it. All right, there you go, my friends at KJ's. So no, they didn't pay me to advertise for them. So let's get into details about bonds. More details. All right. So who issues bonds? Who borrows money on a long-term basis from investors? And the major issuers of bonds are the Federal Treasury. That's the government of the United States. When we have a tax system that brings money in, and then we have Congress that spends money. You've all heard of a budget deficit, and that happens when Congress spends more money than they bring in through taxes. How do they finance or pay for the deficit spending? And the way they do that is they issue bonds, and that's what the Treasury Department does. They issue bonds. All right, then we have federal agencies. These are organizations that are run and supervised by the federal government, and in particular they make loans to certain groups like farmers, and also to banks. They buy mortgages from banks to help banks to originate more mortgages. So federal agencies also issue bonds that have the backing of the U.S. government, or the implied backing. Then state government also issues bonds to build highways, bridges, water and sewer, new school buildings, all kinds of projects that are financed through bonds that are issued by the state. And then lastly, corporations issue bonds. And so when we think of stocks, only one of these groups issues stocks, and that's the last one, corporations. But when we think of bonds, all these different government organizations along with business organizations issue bonds. So years ago, the federal and state governments struck a deal, okay, and they said we will not tax the interest payments on each other's bonds. So if you live in a state and you own a federal bond, then the state government will not tax the interest on a federal bond. And if you live in a state, and obviously you do if you're a citizen of the United States, or maybe you live in a territory like Puerto Rico, District of Columbia, but if you buy a bond issued by that state, if you live in Arkansas, buy an Arkansas bond, the state government will not tax the interest, nor will the federal government. If you live in Arkansas and buy a Texas bond, the state government of Arkansas will tax the interest on the from the Texas bond, but the federal government will not tax the interest on any bonds that are issued by states. So they have a reciprocal agreement. So the interest on a treasury bond is exempt from state taxes and vice versa. But let me point out that a capital gain, which is price appreciation, that results from the sale of bonds is subject to taxation. So if you buy a bond today at $1,000 and sell it tomorrow at $1,100, then you have a capital gain of $100, and regardless of whether it's a state bond or a federal bond, you will have to pay a capital gains tax at the state level and at the federal level on that $100 gain. So it is the interest that is tax exempt, not capital gains. All right, so in order to compare tax-free bonds with taxable bonds, what I mean by that is interest that is exempt from taxation, that would be a tax-free bond, and you want to compare that bond with a bond that you have to pay taxes on the interest. How can you compare these? You have to neutralize the tax effect, okay? And there are two ways to do this. Excuse me. One option is to adjust the yield on the tax-exempt bond so that you can compare it with the yield on a taxable bond. So you're trying to compare two different bonds. How can you neutralize that tax effect? And this is what we call the fully taxable equivalent yield. All right, and here's the formula. We take R, which is the rate of return on the tax-exempt bond, and we divide that rate by 1 minus the investor's tax rate. So R is the coupon rate on the bond, TR is for tax rate, R could be the yield to maturity as well at the IY. All right, let's take a look. For example, the fully taxable equivalent yield of a 4% state bond for a taxpayer in the 30% marginal Fed tax bracket would be, you take the 4% rate divided by 1 minus the 30% tax rate, and you get 5.71%. That is the equivalent yield of a corporate bond on which you pay taxes on the interest. Okay? So if you were comparing two bonds, a tax-free bond that had a yield of 4%, tax-exempt interest, with a corporate bond that had a yield of 5.71% that was taxable, they would be indifferent. This equals this for an investor in the 30% bracket. Okay, so you would be indifferent. So you'd have to have, in other words, if you looked at these two and you might be inclined to say, oh, I'm going to take this bond because it has a much higher yield than this bond. And the answer is no. That is not true. After you pay taxes on this, you'll get a 4% yield on this after taxes. Since you don't pay taxes on this, this is your yield. So one thing you can do is mark up the tax-exempt bond. The other thing you can do is you can mark down or find the after-tax return on your taxable bond, and that's what we're going to do right now. So let's adjust the yield on the taxable bond. So we'll multiply the rate by 1 minus the tax rate, the interest rate. All right, and this will give you the after-tax yield or rate that you can then compare to the tax-exempt bond. So let's look at our example here, 5.71%. The investor's in the 30% bracket, okay? The equivalent tax-free yield is the taxable yield times 1 minus the tax rate, 4%. So these two bonds are equal for an investor in the 30% tax bracket. All right, an investor is considering two bonds. One is a State of Arkansas bond. It has a coupon rate of 4.25%. The other is a Walmart bond. It has a coupon rate of 5.9%. The investor's marginal tax rate is 35%. Let's find the fully taxable equivalent yield of the Arkansas bond. Oh, so let's go ahead and do that. So, for the tax-exempt bond, we have 4.25% divided by 1 minus 0.35. And let's see what we have here. Using my calculator here. Second future value, second CEC, and CEC again. 4.25 divided by 0.65, which is 1 minus 0.35. And you get 6.54%. So that is the taxable equivalent yield on a taxable bond. Okay. Now let's find the after-tax rate on the Walmart bond. That would be 5.9% times 1 minus the tax rate. So you have to give away 35%. You get to keep 65%. So 5.9 times 0.65 is 3.84%. So the state bond has a coupon rate of 4.25%. That is the rate. No taxes paid on this. This is the after-tax rate on the Walmart bond. We're going to go with the state bond, and the same thing here. What this is saying is the fully taxable equivalent yield on the Walmart bond is 6.54%. So since the Walmart bond is less than 6.54%, you're better off, if you're in the 35% bracket, you're better off owning the state bond, even though the Walmart bond has a higher pre-tax yield. All right, and you'll have some homework that will help you clarify this and get some repetitions. All right, now let's talk about how bonds are secured, how you know you're going to get paid back. So there's a type of bond out there that is unsecured. It is secured only by one thing, the legal promise made by the issuer of the bond is called a debenture. Okay? So they're sometimes called signature loans because you're loaning money to the bond issuer and all you're getting in return is a signed contract. It's a promise that they'll pay you back. Okay? So the borrower is simply promising to pay you back. Sometimes bonds are secured by collateral, something of value. Okay? And collateral can be specific assets like inventory or certain pieces of equipment. Or it can involve a broad class of assets like your real estate. That would be a mortgage. That's what a mortgage is. It's a loan that is collateralized by real estate. All right, then there's this concept called seniority. Seniority is preference in getting paid interest and or principal over other lenders and or stockholders in the event of a default or a bankruptcy. So what happens is when a company gets into financial trouble and goes to the courts and says, we're going to file for bankruptcy, they get legal protection from the courts. People can't come in and start taking assets. The court will decide who gets what, all right, and how the process is going to unfold. But what happens is you get a line of people who have given money to the company, debt and equity, and that line forms outside the front door. The question is, where will you be in that line? And of course, you want to be at the front of that line. Chances are greater that you are going to get paid back part or all of your money if you're at the front of the line. If you're at the back of the line, you're not going to get any money. And who stands at the back of the line? Stockholders. Who stands at the front of the line? Senior debt holders. Okay? And even in a bankruptcy, even the senior debt holders often get paid only cents on each dollar owed. And as I mentioned, stockholders often receive nothing. All right, so a common bond indenture provision, remember the indenture is the contract, requires that some or all of the bonds, which is the principal, to be paid off over the term of the bond. Over the life of the bond, we're going to systematically pay the money back before they mature. Okay? And this is called a sinking fund. A sinking fund. And a sinking fund can begin immediately, or the contract can say it won't start for a year or 2 or 3 or 4 or 5. Okay? There is a similar feature that gives the issuer the right, but not the obligation, to buy bonds during a specified time frame for a specified price, and it's called a call provision. So a sinking fund is obligatory. The issuer agrees to buy back the bonds over time, whereas a call provision gives the issuer the right, but they don't have to buy a certain amount of bonds back. Typically, a sinking fund will specify what percentage, or might be up to 100% of a bond issue that is retired over time, whereas a call feature often just leaves it up to the issuer. All right, there's another type of bond that gives the issuer the right, but not the obligation, to exchange the principal of the bond for a specified number of shares of common stock. And these types of bonds are called convertible bonds. You can exchange your bonds for a certain number of shares of stock. Excuse me. All right. The interest on some bonds fluctuates from period to period. So this is the coupon rate, okay? And these are called floating rate or adjustable rate bonds. Some of you may have heard of adjustable rate mortgages. These are loans made by banks that have rates on them that adjust periodically based on what's going on in the marketplace. Well, you have the same kind technique used with bonds called floating rate or adjustable rate bonds. And the coupon rate on these bonds is usually tied to some other index or security, like the yield on the 10-year Treasury bond. So they'll say, let's see if we have, for example, such a bond might have its interest figured as the average yield on the 10-year Treasury bond plus 2 percentage points, okay? So for example, let's say at the end of the first quarter, we find that the yield on the Treasury bond is 3.5%, the 10-year Treasury bond. Well then, the yield on this adjustable rate bond here would be 3.5% plus 2 percentage points. It would be 5.5% divided by 4 because it's a quarterly rate, okay? All right, so floating rate bonds have less interest rate risk than conventional bonds because their rate will move periodically with the market. So the issuer doesn't get stuck maybe with a high rate. If rates trend down, they'll follow down, but there's always the chance that the rate might go up. All right, and these types of bonds, floating or adjustable rate bonds, typically will have what's called a collar, and the collar will limit how much rates can change in the short term and over the long term. So limits are for each year and also over the term of the bond. It may say something like rates can't change more than 2 percentage points in a year or more than 5 or 6 percentage points over the entire life of the bond. All right, how are investors protected? Well, the bond indenture or contract will include provisions that protect investors, and these provisions are called protective covenants, promises made to the buyers of the bonds, the lenders, made by the borrower, okay? And so there are 2 types of covenants that are made. One is called a positive covenant, a positive set of covenants, and these require companies to take certain actions, such as maintaining collateral. If you have collateral, you have to keep it up. Or maybe keeping the debt to equity ratio below a certain percentage, not borrowing too much. And then there are negative covenants that require companies to refrain from doing certain things, like pledging or selling collateral. If you've got collateral there, you can't sell it or pledge it on another bond. Or maybe paying dividends or salaries above specified levels. What you're saying to bondholders is, we're going to pay your interest payment before we pay salaries, bonuses, and dividends. And maybe keeping companies from merging with weaker firms. If your firm is a strong firm financially and you issue bonds, okay, and the bondholders buy those bonds thinking, hey, I'm buying the bond of a very strong company, the last thing those bondholders want is for your company to buy another company that is loaded with debt, and that would drag down the quality of your company and would endanger the bondholders. So bondholders typically have a vote, a say, through protective covenants on whether a company can merge. All right, so we've finished this clip, and we've got one more clip, and we'll be done with chapter, what chapter are we on? 7, bonds.